at SGS Markets Limited, joining us live from Hong Kong. Good to see you on the show once again, Derek. Let me just get the Australian stuff out of the way. We've already had 3 consecutive rate hikes in a row. This is historically something that's never happened before in Australia. When looking at the retail sales data today and looking ahead, do you think there's a case building for another rate hike come February?
I think it's quite unlikely that the central bank will move already in February because they just said that probably they have done a lot of the work already, and retail sales, even if they are rising, they are not changing the big picture of the economy growing at or above potential. So I don't think there is any urgency for the RBA to suddenly accelerate again. But definitely they will keep increasing interest rates next year, and I think that the market right now assumes only 4 hikes, which I think is not enough. I think we will be getting sort of a faster pace than the once per quarter that the market is seeing. So definitely a lot of upside for the Aussie, and I think by the spring it will be trading at 1.02 against the US dollar.
Okay, so it's going to crash through that parity and we're all going to be drinking champagne. Derek, I've got to ask you what is going on with the Japanese yen, because there seems to be so much speculation that there is some imminent intervention after some comments from the Japan Prime Minister saying the yen's rise cannot be left as it is. What do you think they're going to do?
I think that their actions will depend on what happens in the market itself. If the recent strengthening turns out to be the peak, then there will be no need for intervention. And there's a lot of cost to intervention, such as what their trading partners are going to say. So they would love the market to weaken the yen by itself. And possibly a threat of that will suffice, because now after the extraordinary Bank of Japan meeting, everybody knows that the government is indeed pressuring central bankers and is determined to prevent a significant appreciation from now on. So I think that whether by market forces or by some additional policy action, the yen will weaken modestly and will end the year at 89 and move to 93 by the spring next year.
Dariusz, what are you expecting from the ECB later on today? Because there are 2 themes, it seems to me, that they could talk about. The first one is how they're going to restructure an exit strategy. And secondly, do you think they'll make any remarks or pronouncements about the recent strength in the euro?
I don't think that they will talk about the currency. I don't think that euro's strength is dramatic enough to warrant inclusion of that in a major way in their statement or post-meeting press conference. But definitely we are going to see upgrades for growth and inflation forecasts, which will be euro positive, and some more details about the exit strategy which again will be positive for the common currency, because the other major central banks are not going to exit in any way next year, or at least in the first 2 to 3 quarters. So I think that the euro dollar remains on the upside, ending the year at 1.53, moving to 1.57 by the spring. And incidentally, given my outlook for moderate weakening of the yen, euro-yen long positions, I think, will be some of the most attractive in the currency markets over the next 6 months.
Come in on the conversation, Alistair.
Dariusz, Alistair in Tokyo here.
Hi.
Any thoughts on the spat earlier this week between the Europeans and the Chinese over renminbi? And do you think that European pressure on China is going to make any difference to renminbi policy in Beijing?
I'm pretty sure that it will not, because nobody has managed to pressure China to amend their currency policy unless the Chinese decided it's in their own national interest. And the dynamics of the conversations during the European visit and the Prime Minister Wen's press conference suggests that Europe doesn't have much of a leverage over China, which to me is really surprising, because Europe takes more of Chinese exports than the US does. But simply because the Europeans are unable to have strong leaders on the federal level, the Chinese are not really prone to being influenced by them. So I think that renminbi will remain stable through the spring against the US dollar, and then begin to gradually appreciate, ending the next year at 6.72. But in the meantime, euro renminbi will move much higher.
We're going to have to leave it there, but it's always good to have you on the show. Dariusz Kowalczyk of SGS Markets Limited, and Alistair Newton of Nomura International is staying